Hi friends, welcome to the accountancy class. Today in this module we are going to learn about the important concepts used in accounting. The term concept refers to the necessary assumptions and ideas which are fundamental to accounting practice, and the term convention means customs or traditions as a guide to the preparation of accounting statements. The same rules or guidelines have been described by one author as a concept, by another as a postulate, and still by another as convention. This at times becomes confusing to the learners. Instead of going into the semantics of these terms, it is important to concentrate on the practicability of their usage. From the practicability viewpoint, it is observed that various terms such as principles, postulates, conventions, modifying principles, assumptions, etc., have been used interchangeably and are referred to as basic accounting concepts in the present module. In this module, I am going to describe about conservatism concept, consistency concept, and full disclosure concept. Now we are going to study the term consistency concept. The accounting information provided by the financial statement would be useful in drawing conclusions regarding the working of an enterprise only when it allows comparison over a period of time as well as with the working of other enterprises. Thus, both interfirm and intrafirm period comparisons are required to be made. This can be possible only when accounting policies and practices followed by enterprise are uniform and are consistent over the period of time. Suppose an investor wants to know the financial performance of an enterprise in the current year as compared to that in the previous year. He may compare this year's net profit with that in the last year. But if the accounting policy is adopted, the profit figures will not be comparable because the method adopted for the valuation of stock in the past 2 years is inconsistent. Therefore, the concept of consistency is followed in the preparation of financial statement so that the results of two accounting periods are comparable. Consistency concept eliminates the personal bias and helps in achieving results that are comparable. Next concept is conservatism concept. The concept of conservatism, also called prudence concept, it provides guidance for the recording the transactions in the book of accounts and is based on the policy of playing safe. The concept states that a conscious approach should be adopted in ascertaining income so that profits of the enterprise are not overstated. If the profits ascertained are more than the actual, it may lead to distribution of dividend out of capital, which is not fair as it will lead to reduction in the capital of the enterprise. Another important concept of accounting is full disclosure concept. Full disclosure concept states that the information provided by the financial statement are used by different groups or people such as investors, lenders, suppliers, and others in taking various financial decisions in the corporate form of organization. There is a distinction between those managing the affairs of the enterprise and those owning it. The important financial statements of the company are trading and profit loss account, trial balance, and balance sheet. The objective of preparing trial balance is to know the arithmetical accuracy of the business transaction. In the case of profit loss account, the objective is to know the profitability of the concern. That means whether the company earned profit or loss. The objective of preparing balance sheet is to know the financial position of the company. The financial statements are the only and basic means of communicating financial information to all the interested parties. The interested parties may be internal users or external users. Internal users includes board of directors, section heads, departmental heads, etc. External users includes shareholders, creditors, money lenders, government, tax authorities, customers, etc. It becomes all the more important that the financial statements makes a full, fair and adequate disclosure of information which is relevant for taking financial decisions. The principle of full disclosure requires that all material and relevant facts concerning financial performance of an enterprise must be fully and completely disclosed in the financial statements and their accompanying footnotes. This is to enable the users to make correct assessment about the profitability and financial soundness of the enterprise and helps them to take informed decisions. Thank you.